Let's start with share transactions. Now what I'm going to do is I'm going to break this down in a couple of short videos so that when you refer back, and let's say that you are battling with an oversubscription of shares, you can just pinpoint that video and have a re-look at that video so you don't have to watch the whole thing again or scroll through it or forward through it or pause through it until you find the right thing. So today we're going to start with all types of share transactions that you can get. Now the first thing that I want you to do is, before we start with the accounting side of the transactions, is just to go and watch 3 very small, short, it's not longer than 4.5 minutes, videos. Now the first one I want you to go and watch is how does the stock market work? It doesn't help that we start with share transactions and you don't even have the faintest idea what is a stock market and how does it work. So here's your link to a YouTube video. Copy your link, follow the link, and then quickly have a look at that small video. After you've watched that, I want you to go and watch this one, and this is all about shares explained in 3 minutes. So in 3 minutes, they're going to give you the long and the short of what is a share and how does it work. So then the second one that you need to have a look at is this one. In the previous video, I tried to incorporate that in the slides, but that doesn't work. The sound quality is very, very bad. And then in the last one is that I want you to watch is what is a prospectus. So if I'm talking about a prospectus later on, and we're going to talk a lot about prospectuses in questions, that you at least know what is a prospectus, what is the purpose of a prospectus, and why a company has to issue a prospectus before any share transactions are being done with the general public. So there's your link. Go and watch that video as well. Now the rest of the videos is going to be in the form of a type of transaction and how we're going to deal with that transaction accounting wise. Now the issue of shares. Now again, there's a link to a YouTube video, how is shares issued. Please go and watch that YouTube video so that you can see for yourself in practice how does it work. Now, a public company only, can issue shares to the general public. A private company can also issue shares, but you know that it has a targeted market. It will firstly be to its current shareholders if it's going to issue more shares than that originally was issued by the entity. And then it can only be taken up in case of a private company by somebody who is not already a shareholder if the current shareholders give their approval for such uptake of additional shares. But a public company can issue its shares to the general public. It doesn't matter who's taking up the shares. That is totally transferable from the one person to the other person. So therefore, a public company can issue shares to anybody. Now, obviously, when a new company starts, the first shares will be issued to the founders of the company or to the subscribers of a company. Let's take our example again. You have developed some super duper software. You want to launch it into the marketplace. You have found fellow investors in your company. They are prepared to give you a certain amount of money, and in exchange for that money that they are going to give you, which they're going to invest in your company, you are going to give them shares. Same thing with you. You are going to put some of your money into the company, and in return for that money, you're going to receive some shares. A company can also issue shares to existing shareholders, and we call that a rights issue. Now, let's say, for example, a company has been in existence for quite some time. And after 5 years, they want to enter into a huge capital investment required project. Let's take a mine, for instance. Let's say the mine has raised initial capital. It has sunk its shafts. It has started with its mining operations. But let's say 5 years down the line, they have actually discovered a new reef that they want to develop. And for that, they need to sink a new shaft, and that is going to cost a lot of money. So in order to finance that new shaft, they're going to go to the marketplace. They're going to say, listen, who wants to invest in my mining company? And they're going to issue shares to that people. If in the first place they're only going to make this offer of taking up new shares again in this company. So remember, they've already previously issued shares. Now they want to reissue new shares. If they are only going to make that offer to the existing shareholders, then it is a rights issue. If it is to the general public, then obviously it's a normal share issue. It's not a rights issue. So rights issue is when an existing shareholder has been granted the option to take up more shares in a company, and that offer is only extended to the existing shareholders of the company. Now, who issue the shares? The directors issue the shares. The process has been described in the Memorandum of Incorporation, and the shareholders is approving this new share issue at the general shareholder meeting. Now, how do we issue shares? We have to issue a prospectus. In the prospectus, there's certain minimum information that has to be disclosed to the prospective investor. He needs to have some basic information on which he's going to base his decision. Does he want to make an offer to buy some shares in that company? Now, attached to the prospectus, there is a blank form that the guy who wants to invest in this company must complete. And once he has completed that form, accompanied with that form, he must send the full amount of the shares that he wants to subscribe to the company. So what happens is the prospectus gives him information about the company that is going to issue the shares. Once he completed the form, he makes an offer to the company that he wants to take up a certain number of shares in that company. The company does not only accept his offer or to purchase some shares in the company, that offer is only valid if that offer is accompanied with an underlying rand amount of the shares you wish to take up in that company. So that means when a prospectus is issued, there are two dates that's very important. The first date is since what date can a prospective investor apply for shares in this company? And then there's a second date, which is a very important date, and that is the date when this applications is no longer going to be accepted. So that will be the closing date for making any applications to take up shares in the company. Then there's a third date, and the third date is when the directors of the company has made a decision who are they going to allot the shares to. So one, the potential investor completes the form and he sends the form plus the money for the shares he wants to take up in the company to the company, and that constitutes an offer to pay or to purchase shares in the company. The second thing that needs to take place is that there is a window period in which all these potential investors can do exactly the same. They can complete the form and send the money with their offer to purchase to the company. Then at a certain date, this applications is going to be closed. And then on a further date after that closing date, there must be another date where the directors is going to allot the shares to the different prospective investors. Now, all that monies are obviously be banked by the company. They receive the application form plus the money which is deposited in a certain bank account, but that bank account cannot be their current bank account. What is the current bank account? The current bank account is where they actually pay and receive normal trading activities, income and expenses in. So payments and receipts, which constitutes part of their normal trading activities. This bank account is like a protected bank account. No other transactions can go through that bank account except this application money that they're going to bank into that bank account. You will see now if we're going to do share transactions, if we receive exactly the same amount of applications equal to the shares and the value of the shares that we want to issue, then we're just going to allot to all the applicants the shares that they have actually offered to purchase. But let's say that there are more subscribers, so there are more applications than the actual amount of shares that we may issue. Remember, we cannot change that amount of shares and the value that we want to receive by the share issue at a later stage. Once we have decided we're going to issue 100,000 shares at 50 Rand each, that is fixed. That is being described in the prospectus. We cannot issue more than that number of shares at that price. However, if there is not enough interest in the marketplace, and let's say we have 100,000 50 Rand shares on offer, but we only received 75,000 applications for shares, then obviously we're going to allot all 75,000 applicants the shares, and then there will be a shortfall of 25,000 shares. Now we can also make sure that we're not going to encounter a shortfall by making use of a so-called underwriter. Now, a lot of banks are actually, so only banks and other financial institutions actually act as an underwriting of a share issue. Now, what is an underwriter? An underwriter says if you want to issue shares, let's say you want to issue 100,000 shares at 50 Rand each, it says, and you only receive 75,000 applications. He says, for that shortfall of 25,000, those applications that you didn't receive, but you actually wanted to receive that, they say, as the underwriter of this transaction, I will take up the shortfall of 25,000 shares at 50 Rand each. Now, obviously, this underwriter is encounter a huge risk because let's say only 20,000 applications are received. That means that the bulk of that share issue now needs to be taken up by the underwriter at quite a huge cost. So for this risk that the underwriter is taking, he has to take up those shares at the full issue price. But the underwriter charges an underwriter's commission to the company who wants to issue the shares so that they at least can be remunerated for the risk that they're taking and for the service that they perform. So in this special bank account, this monies will be accumulated up to the date that the directors is going to allot the shares. If we have received too many subscriptions or applications for those shares, they have to repay out of that bank account those shareholders or that investors actually that was unsuccessful and did not receive any shares. So they have to give them their money back. For those shareholders that were successful, obviously we're going to issue share certificates and they are now going to be a shareholder of the company. And the value that was allocated in that bank account will now be transferred to our normal bank account. But at the end of the day, it will still now be now. And only now the company is entitled to use that money. Up to the date of allotment of the shares, that money does not belong to the company. That money belongs to the applicants who wanted to invest in the company. It is only after the company has issued share certificates that that the company becomes entitled on the money that was accompanied by the applications of the successful applicants. Good. Now let's say a company A issued 245,000 no par value shares at an issue price of 22 Rand per share. Now guys, what is a no par value share? A no par value share is a share that doesn't have a nominal value. So we have decided we have an authorized share capital, let's say, of 1 million ordinary shares. And you can issue that share now at any price that you want to issue that. So in this case, we have decided to issue 245,000 shares at no par value, which there's no nominal value attached to the share, and we are going to issue that at 22 Rand per share. So what happens? What happens is that we're going to receive share applications from prospective investors. So 22 Rand a share multiplied by 245,000. Let's assume that we have received 245,000 applications. They have sent, accompanied with the offer to purchase, the money, which will equal 245 times 22, which is 5.39 million Rand, up to the date that the closing date of application started, we have accumulated in the special bank account a total of 539,000. We cannot take the counter leg at this stage to share capital because we haven't allotted the shares as yet. At this stage, the money that is lying in that bank account does not even belong to the company, it belongs to the applicants. So therefore, we take it to an in-between account, and we call that account application and allotment account. Now, in this case, we only issued ordinary shares, but if we did issue preference shares, debentures, etc., there will be an application and allotment account for every class of share that we want to issue. So we will have a separate one for ordinary share capital. We have an application and allotment account for preference share capital. We will have an application and allotment account for debentures, whatever we're going to issue. Now the date come, and it was the last date of making any applications to the company as yet. So this is now the end of the story. Now the board of directors have to allot the shares. Now they were fully subscribed. So we wanted to issue 245,000 shares. We received applications of exactly 245,000 shares. So therefore we're going to debit this application and allotment account. So you can see that will disappear out of our accounts, and we're going to credit ordinary share capital with 539,000. So now we know that we have issued the shares, and only now the company can start using this money which is lying in the bank.